In our series overview, we established a core premise that is driving markets right now. Electricity is the real, physical bottleneck for the artificial intelligence build-out. You simply cannot train or run these massive frontier models without an unprecedented amount of continuous power.
Exactly. Everyone is looking for the best way to invest in that reality. So today, we are looking at the most direct beneficiary of that bottleneck. We are talking about the one company that makes both the heavy-duty gas turbines that generate the power at the source and the specialized grid equipment that moves it to where it needs to go.
Welcome back to the Working Thesis. I'm Maya.
And I'm Theo. This is episode 1 of our deep dive series on the AI power chain. Today, we are taking a close look at GE Vernova, which trades under the ticker GEV. This is the company we call the Equipment King.
It really is the bedrock of the modern grid. If you want to understand how the physical world is adapting to the demands of artificial intelligence, GE Vernova is where you have to start. Let's get into it.
One small thing up front. We genuinely love these companies as stories, but we're explaining them, not recommending them.
So treat all of this as food for your own thinking, not financial advice. Stay curious, stay a little skeptical, and make your own calls.
Before we dive deep into the fundamental business operations, we should briefly explain why GE Vernova hit our radar in the first place. This company first showed up on our quantitative stock screens as a name in a remarkably fresh, healthy uptrend.
Right. We noticed it trading steadily up near its all-time highs. It had the kind of relative strength that forces you to pay attention, especially in a broader market environment that can be choppy. Money was clearly rotating into this specific name.
But as we always say on this show, a chart pattern or a strong momentum reading is only the first filter. It tells us where the market's attention is focused, but it doesn't tell us why. What actually matters is confirming that the underlying business is turning and growing to support that price action.
And we want to keep this focus on the business today. If you are curious about the exact screening parameters we use to find these setups, we break down that entire screening method in a separate explainer video. We won't go deep into the technical screening here.
The takeaway is that the screen brought GE Vernova to our attention, but the fundamentals are what kept it there. The business itself is telling an incredibly compelling story about infrastructure demand.
To place GE Vernova in the larger arc of this series, you have to understand its strategic position in the market. In the gold rush of artificial intelligence, GE Vernova is a classic shovel. It is not trying to mine the gold itself.
I love that framework. We don't know for sure whether Microsoft, Google, Meta, or some new startup will ultimately win the AI software wars. But we do know that every single one of them is building massive data centers. And every single one of those data centers requires an immense amount of power.
And that is exactly what GE Vernova provides. It sells its equipment to every data center builder and utility company out there, no matter which AI titan ends up dominating the consumer or enterprise market. It is a completely agnostic supplier to the whole industry.
That is precisely why the market trusts this stock and why it trades near its highs. It is a classic picks and shovels compounder. You aren't taking on the specific execution risk of a single AI software platform.
Instead, you are investing in the physical bottleneck. And because this equipment is so complex, GE Vernova enjoys a massive lead time moat. You can't just spin up a factory overnight to build heavy-duty gas turbines. It takes years of engineering and certification, which protects their market share beautifully.
Let's define exactly what this business is. GE Vernova is a newly independent entity. It was spun out of the legacy General Electric conglomerate in 2024 to operate as a focused, pure-play energy company.
It essentially took the best, most essential infrastructure pieces of the old GE. Today, the business is divided into 3 main arms. First, you have the power segment, which is dominated by its massive gas turbines. This is the generation side of the equation.
Second, you have the wind segment, which covers both onshore and offshore wind turbines. And third, you have the electrification segment. This is the grid equipment, the transformers, the high-voltage switchgear, and the software solutions that actually manage the flow of electricity across the network.
When you put those 3 arms together, GE Vernova acts as a one-stop shop. It provides the machinery to generate the electricity and the highly specialized hardware to move that electricity safely from the power plant directly to the data center.
Very few companies on Earth have that end-to-end capability. In a world where grid interconnections are taking years to approve, having a single supplier that understands both the generation and the transmission physics is incredibly valuable to utility companies.
To really understand the scale of this demand, we have to look at the numbers. And the numbers, which we've fact-checked against company filings and consensus estimates, are staggering. In the first quarter of 2026, GE Vernova's orders hit $18.3 billion.
That is up 71% organically, which is a massive acceleration for a heavy industrial company. And that growth wasn't isolated. They saw expansion across every single segment of the business.
But the real story is the total backlog, which has grown to about $163 billion. To put that in perspective, their delivery slots for heavy equipment are now booked solidly into 2029. The gas turbine backlog alone represents around 100 gigawatts of future power generation.
Let's look at the revenue and profitability side. First quarter revenue was $9.3 billion, up 16%. And their full year 2026 guidance points to total revenue of $44.5 billion to $45.5 billion, with EBITDA margins expanding into the 12 to 14% range.
That margin expansion is key. When your backlog is booked out to 2029, you have the luxury of being selective. You can price your contracts for profitability rather than just chasing volume. This is arguably the most visible, high-quality backlog in the entire industrial group right now.
Now let's zoom in on the specific AI piece of this puzzle, because this is where the growth goes from steady to exponential. In that same first quarter of 2026, the electrification arm booked roughly $2.4 billion of data center-related orders.
That is an astonishing number when you realize that $2.4 billion in a single quarter is actually more than the company booked in data center orders for the entirety of 2025. The slope of that demand curve is practically vertical right now.
And on the generation side, gas turbines have emerged as the crucial bridge power for these AI data centers. Renewables are great, but the sun doesn't always shine, and the wind doesn't always blow. AI chips require constant baseload power running 24/7.
Exactly. Tech companies are realizing they cannot wait a decade for next-generation nuclear plants to be approved. Gas turbines are the fastest, most reliable way to spin up hundreds of megawatts of baseload power quickly, and GE Vernova is the prime supplier.
The leadership team sees this clearly. CEO Scott Strazik has leaned the entire company into this specific demand profile. He is actively positioning GE Vernova to capture the capital expenditure that the big tech companies are forced to deploy to secure their power pipelines.
It's one thing to have demand, but it's another to protect it. Let's talk about why it is so incredibly hard for a new competitor to displace GE Vernova. Heavy-duty gas turbine manufacturing is essentially a three-player club worldwide.
That's right. You have GE Vernova, you have Siemens Energy out of Europe, and you have Mitsubishi out of Japan. That's basically it. The capital requirements and the engineering expertise needed to build these machines create a massive barrier to entry.
And those multi-year lead times mean that customers are locked in. But the real secret to this moat is the installed base. Once a GE Vernova turbine is installed, it runs for decades, and it throws off highly predictable, high-margin services revenue for its entire lifespan.
It's essentially an annuity model built on top of heavy industry. You sell the equipment at a fair margin, and then you service it for 30 years at a high margin.
On top of that, their grid gear, the transformers and switchgear, is already certified and baked into utility workflows. Utility engineers are naturally risk-averse. They buy what they know works safely. That combination of deep technical barriers and workflow integration creates a real moat, and we are seeing their pricing power rise because of it.
Even with that wide moat, GE Vernova doesn't operate in a vacuum. We mentioned the three-player club in turbines. Siemens Energy is really their most direct, large-scale global peer when you look at both the turbine manufacturing and the grid side of the house.
Siemens Energy is a formidable rival, particularly in Europe and parts of Asia. But as we move down the power chain toward the data center itself, the competitive landscape shifts a bit.
Right. When you look strictly at the electrical and grid management side, things like low and medium voltage distribution, you see companies like Schneider Electric and Eaton. They are fierce competitors in the facility-level power management space.
But what truly sets GE Vernova apart from the pack is that it owns both sides of the macro equation under one roof. It owns the generation side with its turbines and the movement side with its high-voltage grid equipment.
That integration is a unique selling point when dealing with a utility or a hyperscaler that just needs the whole systemic problem solved efficiently, from the fuel source all the way to the substation.
We always have to look at the other side of the ledger. No thesis is bulletproof. First and foremost, despite the AI narrative, this remains a highly cyclical, heavy industrial business that is ultimately tied to the broader macroeconomic power cycle.
Executing is also a very real risk. Having a $163 billion backlog sounds fantastic on an earnings call, but delivering that equipment flawlessly over the next 3 to 4 years, managing supply chains, raw material costs, and labor, that is genuinely hard work.
We also have to acknowledge the wind segment. Historically, the wind business has been a drag on profitability, dealing with inflation, supply chain bottlenecks, and warranty issues. Management has been working hard to turn it around, but it requires close monitoring.
Finally, and perhaps most importantly for anyone looking at the ticker today, the stock trades near its absolute highs. That means the market is already well aware of the AI power narrative, and a lot of good news is already priced in.
Exactly. Expectations are elevated. If there is a delay in orders or a margin slip, the market will not be forgiving. This is fundamentally not a cheap value name. You are paying a premium for that growth visibility.
Let's look at the technical read, and we want to frame this very carefully. As of early July, the stock sits near its highs. In fact, it is only single digits below its 52-week high. The momentum reading right now is neutral to firm.
If we look at the downside, the chart shows its 50-day moving average acting as a first line of potential support. If things get volatile, there is a deeper zone around its spring low, which lines up nicely near the 200-day average.
On the upside, the prior absolute high is the obvious near-term ceiling. And if you look at fundamental valuation, the analyst's median target sits just a bit higher than the current price, which aligns with the idea that a lot of the immediate growth is priced in.
But, and this is the whole point of our framework, these are levels that move over time. They are reference points on a map. What you do with any of them is entirely your call.
That's right. We do not provide positions, we are not telling you to buy or sell, and we are certainly not telling you don't chase or how to manage your portfolio. We are just reading the map, and the decisions are entirely in your hands.
Bringing it all together, if we have to distill this entire deep dive down to our one-line working thesis, here it is. GE Vernova is the premier picks and shovels compounder for the new grid.
It possesses the most visible, high-quality backlog in the entire industrial group, stretching out for years. It is arguably the most direct way to own the physical, heavy-duty side of the AI power build-out.
But the catch is simple. The market already knows this story very well, which means this level of quality and visibility rarely comes cheap. You have to weigh that premium against the sheer certainty of the demand.
And that brings us to the end of episode 1. To restate the one-liner, GE Vernova is the most direct picks and shovels play on the AI grid, boasting a $163 billion backlog, but priced for perfection.
As always, please remember that you must do your own research. This deep dive is meant to be a starting point for your own work, never a recommendation to buy or sell any security.
In episode 2, we are going to continue traveling down the AI power chain. We'll be looking at Eaton, the company that serves as the North American electrical backbone, managing the power once it gets much closer to the actual data center facility.
You won't want to miss that one. Thank you for joining us on this deep dive. We will see you in the next episode of The Working Thesis. That's a wrap for today. Thanks for thinking it through with us. We're just testing our theses out loud, one day at a time.
Catch you on the next one. Stay curious and tell us where we're wrong.